We've got a chart on the board right now from the Federal Reserve that shows you unemployment rate ticking up. And every time, if you look at this chart, that unemployment has grown this fast, this high, a recession has followed, or we were already in one.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, normally I'm wearing a suit when we do this show, but I've got my Retire Smart polo. I think the microphone might be blocking the logo a little bit there, but I also want folks to see. I'll do a little Husker flex here on the sleeve because tonight.
Look at those
David,
guns, Chip.
Well, I try. And you're decked out in a Husker polo here. We have a lot of fun things that we do at Retire Smart. We have the State of the Market address. We've had some great Christmas parties. We sponsor the patriotic parade and so forth. But we're doing something tonight that we have never done before. And David, we have 400 people signed up for Night at Memorial. This is Memorial Stadium, Lincoln, Nebraska, Tom Osborne Field. The new field, I understand, has been put in. The new
and
turf.
We're the first folks to get to be on it.
We're going to be on it for, I don't know what to call this, David. It's part picnic, it's part jamboree, I think we're going to be kicking field goals at one end of the field. It's just going to be.
I think I'm going to do a 40-yard dash against all the advisors and
make sure we have some medical personnel on site as well. Then it's going to be a blast. This is in connection, of course. We're one of the main sponsors now of Nebraska Athletics, and so this is one of the first manifestations of that partnership. But just quickly tell us how it came together and what's happening.
Well, when they approached us for sponsorship, of course we were happy to do so and align it. But one of the things that we had to go back in, and I was like, no, we need to have a little something for our clients. We want to get some access, so we put in a provision where we can use some of the facilities within our sponsorship deal, and because a lot of fans, and again, listen, not being raised in Nebraska, but now being fully assimilated for over 8 years, have lived here. This is a pretty big deal. And, these folks have been coming and supporting the Huskers like no other fan base in history. And I mean, we got a sellout streak going all the way back to 62. But a lot of folks have never had the opportunity to stand on the field. So we just thought, what a cool thing it'll be for, and we've already gotten emails in, clients super excited about it. So anyway, it should be just a lot of fun, and I'm glad we can give the opportunity. We told clients to bring their kids, grandkids, etc. And we got several special guests coming. So, it should be a really fun night.
Well, it's a big week every week's a big week at Retire Smart, but we also have one of the highlights of our charitable philanthropic calendar at Retire Smart. The Journey of Hope is coming through town, and your brother Lou was one of the founders of this project. Quickly tell people about Journey of Hope.
Yeah, so these guys and my brother with his fraternity, they I think they were inaugural. I believe it was 89. He'll correct me if I'm wrong, but I think it was 1989. He biked from San Francisco, I believe, all the way to D.C. And I'll never forget how proud my dad was of him. So back then, this is before he could, had graphic design like you do. We had little pins put into a map, a good old-fashioned AAA map, and framed for him of every stop along the way they biked across the country. But they were raising money for kids. And so now they've blown this into the Ability Project, and there's a couple of different charities in each city that sponsor this. And so it helps kids with disabilities. It's a fantastic organization. And so the cool thing is so we carb these kids up. They need carbs, right? So when the bikers come through, not only do we write a check and sponsor, but we feed these guys. And so they last year was the first year they came to the office, and we got them, of course, a Midwest classic. So Casey's Breakfast Pizza. So no sponsorship there, but Casey's, if you do want to sponsor going forward, we're happy to accept the pizzas for free. But anyway, so we fill these guys up with some carbohydrates because they're biking, 100 some miles a day, et cetera, having some fun. And the great thing is these are college kids looking to go out in the world. So, last year I got to engage with them for about an hour, just answering questions on career. And there were 3 or 4 finance majors in there. And so I love talking with them. But anyway, it's just a great experience all around. And my brother Lou, this one's near and dear to his heart for sure.
Well, it's always it's fun too. There's a dinner dance in the evening, and some of the special needs community comes out, and it is uninhibited joy. Those of you who sample our YouTube channel, I think our producer Shannon has put up clips in the past, and he'll probably have some from this year of the dancing and the merriment, and it's a great time. It's a great cause. Journey of Hope, if you want to learn more about it and perhaps get involved yourself supporting it. All right, David, You and financial advisor Alex Murray dove into the big, beautiful bill last week. I know you and financial advisor Josh Cheadle are going to dig into it in the second segment of this show. I think we have a couple of questions about it in the Q&A, so I don't want to spend a whole lot of time now, but I just want to get your general take. Elon Musk is so upset he's starting a third party. Are you glad that the big, beautiful bill became the big, beautiful law?
Well, yes, I'm glad it passed in general, but just because there's provisions in there, we would have the largest tax increase on the American public if it didn't, right? Would have been over $5 trillion in tax increases on the American public. And by the way, Chip, we just finished our fiscal year, right? Our fiscal year basically ends every June 30th as a country. $5.1 trillion in revenue. So we broke the 5 trillion mark in revenue. We do not have a revenue problem in the U.S.
I thought the tariffs were going to destroy us. It was going to be Armageddon, financial Armageddon.
Yeah. So, and again, we can get into all that later because we have tariff letters going out again this week. But anyway, but there's a lot of pork in the big, beautiful bill that is upsetting. There's some provisions in there I don't like. We're going to do a breakdown of the whole thing. For instance, so if you happen to be a fisherman in Alaska, you get a one-time $50,000 deduction. The only state that gets it, that was to get Lisa Murkowski's vote, right? Akin to the Cornhusker kickback, you remember? We have a bridge there's a certain bridge here that you will never walk on, right? Simply because there's a pedestrian bridge to get you across the river to Iowa. But I know you will never set foot on it because of an earmark. Well, that happened in this bill in the late hours. In the last 6 hours, there's 14 such pork things that were stuck in there that would make the average person
sausage-making process.
Yes, but anyway, we're going to break down. We're going to put a video out on this stuff in detail.
Well,
later.
I know you and our in-house accountant Evan Marshall have also been digging into the tax-related particulars of it.
Yes.
So more to come on that front. We may have to start a David Brooks political futures index. You would have cashed in big time last week. We were talking about Don Bacon's announcement of his retirement when his current term is finished. And he's talking about spending more time with family and so forth. And you opined, or on the other hand, what if he's just kind of catching his breath and regrouping? And, that every 2 years, there's always an election around the corner when you're in the House, regroup and maybe run for something else. Well, it was just a day or two later that NBC published an interview with Don Bacon. Here's the headline: Centrist Representative Don Bacon is done with Congress, but open to a potential presidential bid. And in the interview, he also talks about possibly running for governor of Nebraska. Well, did you have an inside source? What?
I did not, but I understand how politicians think.
Okay.
And I've been around them a long time. And, I don't know who's advising him. Like I mentioned, he might want to run for the Senate seat. I'll just say it on the air right now. Don Bacon has zero chance of winning the presidential election at this point. Not in the next 2 cycles. There's zero chance. I'll just go out on record and tell you.
Okay.
I don't know who's given him the advice there, but I don't think he could win his district this next go around. We've talked about that, and I think that's why he's stepping aside. But again, look, you consider Don a friend. I do too. He's been a centrist. He voted as a centrist, so he's done nothing wrong. He ran on who he is, and he voted
and
on
he governs
who he is.
that way.
Yeah, and that's what I'm saying. He was who he says he is. I just don't think that is wishy-washy as he is too middle of the road. You can get through a primary season and get the nomination of any major political party, but unless he plans on maybe joining a new political party, who knows? We know one of those has been formed recently, but anyway, we'll see.
Well, I appreciate he's been willing to fight the good fight in a tough district for 5 times out. But anyway, we'll keep an eye on that. All right, David, the June jobs number came out, and actually you sent the team a barrage of items related to this. I'm going to deal 3 of them to you and let you work your way through. Just in overall, we've got the June jobs number, which actually was a little higher than estimated, but then you sent a chart on the private sector, and there was actually a net decline in the private sector. And then you sent some information about job cuts in relation to recession. David, please take us through this.
Okay, so we get what's called the ADP report, and it's become less accurate for what we're going to get. So that comes out typically Thursday after the end of the month, right, from the previous month's hiring on private payrolls. And so ADP is the largest payroll provider in the United States. So you used to be able to actually count on that number to give you some relative understanding of what's coming. Well, we have a chart on the screen right now that shows you those private payroll numbers with ADP have been drastically dropping consistently here for a long time now. However, the accuracy between that number and then what gets reported on the first Friday of every month, the government's idea of jobs number, which is done from a survey, all right, was drastically different this time. So, yeah, ADP reported only 33,000 private sector jobs, and then the jobs number came out. We were expecting about 110,000. It was 147,000 jobs. Yet the labor participation force, we lost 800,000 people, just vanished out of those numbers. And so unemployment basically looks pretty good down there around 4.1, 4.2.
But the participation rate went down
significantly.
In other words, able-bodied people who could be working,
right?
Just
and
choosing
so
not to
we've got a
participate.
chart on the board right now from the Federal Reserve that shows you unemployment rate ticking up, and every time if you look at this chart that unemployment has grown this fast, this high, a recession has followed, or we were already in one. So again, I've been telling people I believe that we've been in what we call a rolling recession for a while. It's been rolling through manufacturing, et cetera, and then service industry. It's not been called a recession. You have the Federal Reserve who refuses to lower interest rates, yet they keep trying to say we're data dependent. Well, the data would tell you if you cut 50 basis points last September with inflation at 3% because it was heading towards your goal, and inflation has now been below 2.4% for 6 consecutive months, and you won't lower rates, then you are, in fact, being political, right? And so the other odd duck in that payroll number, Chip, is in June. Where do you think you would see job losses naturally take place? Just what sector of the economy comes to mind?
You would think education would be
Right,
slowing
the end
down
of the
in
school
June,
year.
but
So-
the story says no.
But that's the thing is over half the jobs created in this job report, if it were true, were government and education
It's
jobs.
in that first graphic that we showed, 73,000 of the 147.
Well, the government's not supposed to be hiring. They're supposed to be
Yeah.
firing people
And
if DOGE is
education
taking
was-
effect, right?
yeah.
And education, you would
That
think
was the
jobs would
driver.
go away. So again, can you trust the survey? I don't know. We've been talking about that for the last 2 years. So it's just not been it's not very rosy when you look at the data. Now, then you can look at leading indicators of where jobs will be in the future. And we're seeing job cuts start to mount, the Challenger jobs report, et cetera. And then when you look at exports and what we're sending out, right, things we're shipping, we had a massive drop in exports unexpectedly this past month. Well, if companies are shipping out less goods and services, what does that tell you about their future of the jobs market, right? So there's just a lot of data here that tells you just be cautious of what might be coming here in the near future.
For those who check us out on YouTube, we've got a chart on that export drop as well. Up next, we have a team of a dozen licensed financial advisors at Retire Smart, and we have a wrangler who spearheads the effort to keep all of our advisors on the cutting edge of excellence. His name is Josh Cheadle, and he joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David Brooks is sought after nationally as a trainer of retirement planners, but he also constantly upgrades his own knowledge of best practices, and he demands the same of all the advisors on our team. The man who helps make that happen joins us now. David, please welcome Director of Wealth Management, Josh Cheadle.
All right, thank you, Chip. Yeah, in the studio joining me once again is our Director of Wealth Management, Mr. Josh Cheadle. Josh, how we doing, bud?
Good to be back.
How's everything going? You actually recently had a pretty fantastic vacation, we'll call it. You
yeah.
headed up to Alaska. What was that like?
Cold and wet, but absolutely beautiful. Never been there before.
Well, I
What
think
a
it was
neat
funny
experience.
because you were telling me a story in a small town that I have a pretty cool story from, Skagway,
Yep.
right? It's a little town that all the cruise ships stop in
Yep.
along the inner passageway up there. And I actually ran into a bartender from the place I eat lunch at almost every day when I lived in Florida, right across the street from my office. I'm like, what a small world.
Right.
But isn't it beautiful up there?
Oh, I loved it. It was absolutely beautiful. Like I said, the weather was a little chilly, as you would expect, which was nice because it was 110 degrees here, I think. But yeah, we loved it. It was a fantastic experience for me and the family.
That's awesome. Well, speaking of fantastic experiences, Congress keeps us on our toes,
They
right?
do, yeah.
So we talked about it in the first segment with Chip there, but the big beautiful bill, as it's called, was passed and signed into law. And part of your role here, so kind of explaining, is you're like the player coach, if you will. You've been in this business for quite some time, and we talked about that story last time you were on, but you help lead all of our advisors, which we have quite a few of now, to understand how to quickly adapt and tweak the planning process, the plans that we've actually written for clients when things like this change. Legislative change happens all the time. We talk about your plan has to be flexible, if nothing else. Can you talk a little bit about what's going on right now with the team?
Yeah, of course, we anticipated quite a few different potential changes over the first half of the year. And most of the planning that we've done for our clients, are whether new or tenured, have included more than one plan, depending on whether the Tax Cuts and Job Act or the Big Beautiful Bill as we know it now was extended or was put in place. And so now it's time for us to implement the plan that we had set forth with the intention of the Tax Cuts and Job Acts being extended. But it's not just income taxes, right, that the TCJA the extension of that allows us for planning, but also the different nuances of the bill that I know you spent hours in the last week learning.
Yeah, we've been digging, Evan and I, and Evan is our chief tax planning officer and CPA in-house, and he and I have both attacked it, if you will, from different angles. So, there's, and we always often talk about politically, there's campaign promises, and then there's what's reality, right? So this promise that we're not going to tax Social Security, so that is not actually in this bill, right? So, but there is a special senior deduction that radically changes some of the planning we're doing for clients that are 65 and older and are actively doing Roth conversions. We have to recompute the math because right now they're getting basically an extra $6,000 a year, but it's only for 25, 26, 27, and 28 tax years, right? So if we were doing larger Roth conversions for that client, their effective tax rate, once we phase them out over $250,000 in income, actually would go up significantly. So we have to actually recalculate some of those numbers. But again, this is what real planning really is all about, right? And why I've got to have somebody like you in-house when I give the information to go take it down to the troops, so to speak, right?
And we spent time earlier this week, right, going over the high-level aspects of the bill, specifically what you just talked about with the $6,000 increase to the seniors, not directly reducing their Social Security, the impact of their Social Security taxes, but nonetheless spent some time this week. But next week, as you mentioned, Evan's going to spend quite a bit of time with us and our team to ensure that we know all those nuances that we talked about.
Well, and I would tell you, this will help those that were less fortunate in saving for their retirement. Now, a lot of our clients have amassed some pretty good dollar amounts, so we have to do the unique planning we're talking about. But the great news is just for the general public, right? Over 2/3 of all retirees, their number one income source is, in fact, Social Security. And this will actually take 91% of Social Security recipients this year, according to the Tax Foundation, could potentially not pay any tax on that number, right? It was about 83%. In other words, the reality is the bottom half of society that's retired, it's their only income. And that's a sad state of affairs. But the good news is that some of those folks were paying tax on some of that income, even though it was their only source or had very little other sources that created the taxation. So this is actually going to give some folks a little bit more take-home pay. And we're talking about the folks that need it the most because, everything costs 25 to 30% more than it did just 5 years ago. Social Security has not kept up with that inflation number. So it's really beneficial to the bottom two quartiles of income recipients in retirement in America significantly. Now, what I want to pivot to is something I know you do as well. We do as my wife and I and Melissa do, and we do as a company is charitable giving.
That's right.
There is massive opportunity to do charitable giving this way better than what will be next year because you're going to lose some of the deductibility of charitable gifts, unfortunately, starting next year. I don't like that provision in the bill, but it is what it is. So one of the strategies I talk about on the air sometimes is called a donor advised fund. I'm going to probably have 10 of the advisors create their first donor advised fund for themselves this year based on what this tax law says. So I just think it's fun to start doing this planning level and sharing down to the troops, if you will, what they can do and what's possible because there's some amazing opportunities if you're proactive in your planning.
Well, it's so important. You mentioned, right, we have to practice what we preach and to implement it for ourselves allows us to know all the details to do the same for our clients. So that's one of many aspects of tax planning that we work on each and every day, each and every week, and become as familiar with it as possible so that we can, in fact, implement those same plans for our clients.
Well, let's pivot real quick, too, because here in Nebraska, one of the things that We are considered a red state, even though District 1, we're going to talk about that later, I think, with Chip, or District 2, excuse me, is a purple district, if you will. Omaha is a high property tax state.
That's right.
So, yeah, we're like in the top 10 of worst states, right, when it comes to property taxes.
Yeah, top 5. We're number 45 out of 50 in property taxes.
And that's not a good thing. You don't want to be there. So the SALT deduction, so this is state and local tax. You have to itemize your return. Just so you know, less than 10% of tax filers every year itemize their returns, when it was about 30% prior to the previous big tax bill, the Tax and Job Act of 2017, otherwise referred to as the Trump tax cuts. So I will net benefit from this SALT deduction because you're going from $10,000 up to $40,000. So if you have property taxes over $10,000 like I do, I complain about it all the time, I get to actually write that off now instead of just the cap plus charitable giving, et cetera. So you can, your state and local income tax, there's not a lot of filers it hits, but this unfortunately benefits people in bluer states, if you will, that don't fiscally run sound budgets, and they're just passing that tax burden on to you and I all across the U.S. But if you understand how to do this, you can take advantage of it.
Yeah, of course you have to itemize to get that $40,000, and that will continue to go up incrementally until it phases out in 2030.
Well, sneaky. This is part of how they actually had to actuarial pay for this bill. So I think Evan and I are going to do a whole webinar on this bill probably in the next week or two that we'll post right here on this YouTube channel, pending compliance review. But anyway, where, the reason they put the senior deduction in there is so that they wouldn't actually itemize, because less people are actually going to use that SALT deduction. And then there's a phase out on it as well. Once your income goes over $500,000 on that SALT deduction, your effective tax rate really jumps. So there are a lot of, we'll call them white collar professionals or entrepreneurs that are making, let's just say they're making $600,000 a year. I can tell you one right now, a doctor that I know that is making right around $620,000 a year. Well, he could actually cut one day out of his schedule, take his income down to about $580,000, and drastically, under this provision, reduce his effective tax bill. So do you want the extra day off, or do you want to pay 55% tax on that last $100,000 you earned? And that's the decision the client will have to make. But again, this is where you have to dig into this bill and understand how to explain to folks where they want to do. So if you can control your income, which is something I do very well, and focus on exactly what my taxable income will be every year, I can take it up or I can take it down. And we show clients and retirees every day, even what we call bread and butter retirees, how to do just that with our own proprietary software. And you get to lead the coaching on all that.
Yep, absolutely. And it's such a rewarding experience. That another aspect I don't want to overlook, with about a minute left in this segment, is the business owner clients that we have. There's some aspects of this bill for business owners, specifically writing off some of their assets, mechanical, things like that.
Well, and bonus depreciation is back, and a lot of business owners need to pay attention to that. On top of that, if you are going to, R&D credits are back. If you're going to build any kind of building or put in service anytime in the next 4 years a building, there are massive tax credits available for you if you didn't know that. So lots to unpack, and we're going to have our next business owner tax class, our SEPA class, with Evan, Colin, our estate planning attorney, Mike Schudel, our other SEPA, myself. I believe that's coming up August 22nd. But anyway, so if you're an entrepreneur, you do not want to miss that class. It'll be about 8 o'clock in the morning, so you can get here, get in and get out in an hour and get some information that you can use. But anyway, lots to unpack. This segment flew by, man. Thanks for stopping in the studio. We got to keep rolling, bud.
Yeah, thanks, David.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question is about international finance. Did you see the financial secretary from the UK crying in Parliament over the state of Britain's finances? England is the home and foundation of Western civilization's banking and financial system. What the heck is going on?
I actually did catch that, and if you didn't realize it, the United Kingdom is basically bankrupt. I mean, they are in dire straits, and has a lot to do with the open border policy they have had in the last several years. They have imploded with immigration, and again, not saying that's right or wrong, but they've given away benefits and given away social programs with zero chance of collecting revenue. In fact, There was a story where someone followed a couple that immigrated to England 12 years ago and has been on benefits every year since, has both able-bodied people and have not gotten a single job, have not paid one penny in tax. And you can't do that. As much as people have this heart for, we want to serve the world and do things, listen, you have to produce. This goes back to, Jamestown, right? and the diaries, et cetera. You've got to have people incentivized to be productive in life, or society will end up falling off a cliff. And that's what you're seeing happen in England. And England is near and dear to my heart. As you know, I spent a great deal of my youth there. Yeah. So, but and a lot of friends, but it's just not the same country it once was.
David, you are passionate about good leadership. You and Scott Frost came here to Nebraska about the same time. In fact, you're a Central Florida graduate. Things have turned out a lot better for you than they did for Scott Frost here. But he popped up in the news. He's back at Central Florida now as the head football coach. And Nebraska came up. And so the question is, here's the question. What do you think of Scott Frost's comment that he took the wrong job when he came to Nebraska as head coach?
Gee, how wrong was it to spend all $30 million that was given to you, Mr. Frost? So I was quite upset with the comments, and as you mentioned, he took my college to the promised land. We went undefeated back in 2017, and shortly after I moved here, about 9 months later, he came up and took the job, and was like him coming home, a homecoming. He was rewarded with a very large financial contract. Yeah. There's multiple stories in Lincoln of things that went awry. We don't need to bash him here. No. But the thing is, the Nebraska fan base has always been pretty forgiving. So, all right, just move on. That chapter's closed. We don't want to bash. But this recent comment, I don't know why he thought to do this, but he is going to draw the ire of Nebraska fans. So it'll be interesting if we can get UCF on the schedule. That would be
maybe a bowl game.
Something to see. But and on social media, Nebraska fans are blowing him up, and I think rightly so. I think he's I think he's just stepped in a can of you know what, and
it just seems strangely unnecessary and if he would just say, Nebraska fans, I'm sorry, I blew it. But good luck and whatever. Everything would be fine.
Well, you talk about good leadership.
Seem to do that.
I mean, when you're in a leadership role, you need to be a little considerate with what you say. If I said everything on this show that I'm actually thinking, I don't know, and so I will just tell you, you have to be realistic, and there's nothing wrong with having strong opinions on things, but when you go public with everything, that's a little different.
Keep in mind the aforementioned Lou Brooks, your brother, is the compliance officer. So,
he and I disagree on multiple topics of things. Imagine that. But I think healthy debate is a great thing. I recently got into a healthy debate with someone I graduated high school with many, many years ago and haven't seen in a while on a particular topic. Anyway.
All right. Hey, speaking of doings in Lincoln, there's a question about our Lincoln office. Do I need to travel to Omaha to get the full Retire Smart program, or would I get the same thing from the Lincoln office?
Oh, you'll get absolutely the same planning process that happens in our Lincoln office as does in our Omaha office. The only difference between the two is the Lincoln office is about 25% the size of our Omaha office is quite large, right? We have a beautiful office in Lincoln, Nebraska.
And getting larger. Yes. We've got Lexi and Caden, our two newest faces in the studio with us today. I have it on good authority that Caden's grandmother is a regular listener, as a matter of fact. So thank you, Caden's grandmother, for listening.
We hire smart people. So anyway, the Lincoln office, you're going to get the same planning experience, but I will put a caveat. We do educational events that only happens right now in the Omaha office. So that's really the only difference. And there's some client events that will only happen in Lincoln now with our sponsor with the Huskers. So our Lincoln clients get closer drive to that. And there's some events like we do a quarterly wine tasting for new clients, things like that only happen in the Omaha office right now. So
we've got the Psychology of Retirement movie coming up in Lincoln. It's running during the breaks in our show.
So just make sure that you stay on the event page. And if you become a client, make sure that you opt into our texting service, et cetera, to make sure you're aware of all the events, et cetera.
Want to squeeze this in just briefly, David, because I think you and Josh just touched on this, but let's make sure we've got it clear for listeners and viewers. Quick question about taxes, David. In the big, beautiful bill, what ended up happening with the SALT tax. That, of course, is state and local tax that you can deduct from your federal bill.
Yeah, so I think what they're asking is what happened with the SALT deduction. So it's not a tax, it's a deduction. So that is exactly that. You can deduct your state and local taxes from your federal income tax return. But that's been capped at $10,000. That now went up to $40,000, including this year. But it's only going to be here for 4 years. It will phase out. And then there's a phase out on your income. Once your income goes over $500,000, you start to lose part of that deduction. So we're going to again go through that whole thing in a video that we'll post to this channel, on the YouTube channel.
When you do that video, will you please point out that this SALT deduction rewards the fiscally irresponsible states who gouge their taxpayers with state and local taxes, and those who are responsible get shafted by it?
No, absolutely. So California, New Jersey, et cetera, New York, these states benefit widely, their taxpayers do, with this over other states.
All right. Up next, we just talked about the SALT deduction. What did the big, beautiful bill end up doing on taxes and Social Security? We'll tell you about it next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, now you and Josh touched on this matter, but let's flesh it out a little more. The headline is, this is a headline from CNBC. Republicans' big, beautiful bill touts tax help for seniors on Social Security. Now, you noted with Josh that Trump had a no tax campaign promise on Social Security. That isn't what was done, but what was done?
Yeah, so seniors are getting an additional $6,000 deduction. So a married couple, that's $12,000. So, and standard deduction went up this year as well. So a lot of people don't realize standard deduction was $15,000. It's actually $15,750 now for 2025. So everybody got that. Everybody got an extra $750 of non-taxable income this year. So basically, a married couple now has got close to $45,000 if they're over 65 in standard deduction. Well, the average married couple is only collecting about $52,000 in Social Security. And because the difference there it is below the threshold, they basically effectively are paying little or no tax on that Social Security. And again, 8 out of 10 seniors that are already on Social Security over 65 will no longer pay tax on their Social Security. So he kind of got it done, but here's the caveat. Like many of the provisions in this bill, again, you're going to want to watch the our probably 30 or 50 minute long, who knows, when we go through this video we post on the YouTube channel. It's temporary. So the tax is coming back. And even the provisions that say are permanent, i.e. the tax brackets, well, if you've studied history as we do, Chip, we know none of that is permanent, right? It's until we get another elective body that changes the legislation, tries to go a different way. And now because of this, we're going to have $45 trillion in debt by 2032. So how long do you think we can keep tax rates here? I'll leave that up to you.
I'll try not to think about that. David, there is a crypto tax bill working its way through the system, and you said your eyes went blurry reading it. But you did read it, and you shared with the team a summary.
It's actually part of the bill. This is law.
This is part of the big, beautiful
bill. So
what's
one of the many provisions.
What's the crypto tax?
Well, so crypto tax, they're basically eliminating what's called the wash rule. So if you bought a stock today, Chip, held it for say 8 months, then sold it at a profit, then bought it back 3 days later, and then sold it again. If you don't stay out of that position for 30 days. We consider that one transaction. In other words, so there's what's called the wash rule, where if your taxes can get quite complicated if you're day trading or what have you. But so basically with crypto tax, there is no wash rule. So you could buy and sell crypto. And the reason is they're trying to actually make it into currency, which I've talked about. Cryptocurrency is not currency. It's anything but. However, now with the advent and the rulings on the SEC and the Supreme Court on what's called XRP or Ripple, the stable coins, those are going to become very, very prevalent very quickly in cross-border transactions. And so people are going to be buying and selling these things daily, corporations in particular, to transact foreign currency exchanges, all kinds of things, and move money around. So if they were going to be treated like stocks where there'd be all kinds of complications tax. So that's why they had to put in there. But this would lead to a potential benefit, a tax benefit for someone that does trade crypto. And there are many people out there. Again, we're not advocating you go buy or sell any of this stuff. But again, I just look at the bill and interpret what the data means and tell who's going to benefit and who won't. That's what our job is when it comes to tax planning. So it is a unique provision in there. And it did catch my eye.
The analysis that we do here, David, it's not throwing darts at the wall. It's not a crystal ball. You and all of our advisors and the support staff study data. You study patterns. Well, let's look at what's happened, because the past is prologue. A lot of times you can predict what's coming by what has happened before. And so I thought of all that when you sent the team a chart. This is about so-called gaps in the S&P 500 and then how they're filled and what it means for the economy. Take us through this.
All right, so what we have on the screen is a weekly chart using my favorite charting statistical way to look at it, which is called candlesticks, right? And when you chart with candlesticks, and you can do this by, minute by minute, second by second, tick by tick, daily, weekly, et cetera. So I like to look at weekly for long-term trends, and each candle represents the action of the market within the week, the particular week you're looking at. Well, when we have a gap up or down, gaps sometimes get filled. Traders like to see gaps filled. In other words, so if you go back here to the first week of May, around May 5th, the S&P gapped up a pretty good couple percentage points to start the following week, right? So we were coming out of the tariff tantrum, if you will. And then we had news that, okay, we're going to, pause tariffs. And that next week, the market gapped up a couple percentage points. So the second week, so if you look at the week of May 5th to the week of May 12th, there was a pretty significant gap up.
All right. So the upward trajectory that we see in the candlesticks.
Right. And in other words, you see a gap, the close of one to the open of the other. There's a gap in the chart.
All right.
So every weekly gap up going all the way back to 1981, before half my employees, probably 75% of my employees were even born, maybe 85%. Scary thinking about this. We're getting old.
They keep getting younger and younger.
Every one of those gaps has been filled. In other words, the market comes and fills those gaps. It just has a unique, now again, that's a technical analysis. No guarantee it will happen, of course. But if you don't learn from history, you're not gonna, it is, as you said, it's a pretty good precursor of what's going to happen. So why would that gap be filled? And that gap was down around 5,800 points. The S&P is now cleared 6,200, all-time highs again today as of this recording, right? So that would be a good little drop, right, of almost 500 points on the S&P, 8 or 9%. You'd have to see the market pull back to fill that gap. Is it going to happen? Well, I can't guarantee it will. High probability it does. So another way to look at it is, how overvalued is the market? Well, technically it's telling you it's ripping to all-time highs. So I sent everyone on the team a chart just this morning, just showing you just how big the U.S. stock market has gotten. We've always been basically the largest market in the world, but we used to only be about 15 or 20% bigger than the other markets. We are now larger than the next 12 largest markets, stock markets on the globe.
Wait. Larger than the next
12 combined.
Combined.
We are over $63 trillion in value in U.S. markets.
Almost 64 on this total market cap
The next
chart.
12 are only about 53 trillion combined.
19, 17, 7, 5, 3.5, 3, 1, 1, 1,
so
1.
If that reverts to the mean, right? Again, I just, data's data. If it reverts to the mean, that would mean a 50+% correction in U.S. markets, NASDAQ, S&P, Dow, all of them. Now, people think, oh, that would never happen. Well, it's funny, Chip. I've been doing this a while, as you often want to point out. I earn these gray hairs. We've had 2 market corrections in my career over 50%. So certainly it tells us, if we don't learn from the past, it's probable it could happen again. So again, I'm not saying that's going to happen. I'm telling you should have caution, especially if you're at the finish line. If you're 6 months from retirement, Chip, should you have all your eggs out in that basket that's at full risk? Certainly you need to grow your assets and have exposure to the equity markets to fight things like inflation, but you need to make sure you have somebody helping you risk manage your portfolio before you go walking into retirement just thinking everything is rosy because the markets are at all-time highs.
Now, that is a great segue to our final story, because I'm the tail end of the boomers, and you're the front end, I think, the front wave of Generation X, right? I'm born in 62. You're born in 68.
So I just want to make sure that
happy birthday, by the way. You just had a birthday.
I did, but I still want to point out that I'm not only even younger than you, I'm in a whole different generation. So I just want to put that on air.
One of my favorite moments, I'm the oldest of my 5 siblings, and when my brothers and I together, and said, so who's the oldest? I dine out on that for weeks. But anyway, all right. The headline from Fox Business is Generation X is not confident about retirement. That's according to a survey that was done. I'm just asking, do you agree? I mean, you know all about retirement, but are people in your generation not confident about retirement?
Yeah, because a lot of folks didn't do the legwork required to get themselves in position for retirement. Now, you got to remember, my generation is significantly smaller. There's less than 40 million Gen Xers when there were almost 90 million baby boomers, right? So we're a significantly smaller generation, less than half the size. And so a lot of Gen Xers were going to be dependent upon inheritance, was their plan, if you will. However, there is always time to put together a plan and keep the ball rolling forward. So if you haven't started planning, I would tell you start today.
Well, Rita Ossoff of Fidelity says in the story, planning does not stop at retirement. That is so true. So much of what we do here is post-retirement. Now let's make sure we're managing your assets and your risks, as you just noted, properly.
Yeah, I will tell you, a friend of mine works for one of the big box financial planning firms out there, one of the largest in the country, and they put together this big 3-inch binder and hand it to their clients in this little embossed thing, and that's the plan. And I'm like, well, how often do you go open the binder?
Right.
Never.
Yeah.
I'm like, well, what was the value of that binder, right?
No.
It has little value. You must have a proactive plan and a planning process that's going to adapt and adjust to legislative changes, market changes, different optics, the client's changes, health changes. There are so many factors into planning pre and post retirement. And I just think a lot of folks, unfortunately, get it completely wrong.
That'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. There's no charge, there's no obligation for our events, but you must register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, go Big Red. Hope you had a blessed and prosperous week, and thanks for those of you that joined us at Memorial Stadium. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. The University of Nebraska and University of Nebraska Athletics, also known as Nebraska Cornhuskers, are not clients of Smart Wealth LLC nor Retire Smart LLC. Playfly Sports Properties, on behalf of the Nebraska Cornhuskers, was compensated for this endorsement, as such term is defined under SEC Rule 206, subsection 4-1. For more information, visit retiresmartnow.com/cornhusker disclosure or email compliance@retiresmartllc.com.